Okay, welcome everybody to episode 76. We are doing a Sunday stream today. Typically we do Friday, Saturday, but figured we'd see how many people show up on Sunday. So mix it up a little bit. I can check the analytics later on and see what the viewership was like. I don't know if I'm competing with any major sports today or a bunch of people going to church perhaps, but we will see how a Sunday stream goes. So thank you everybody for joining. Going to talk about, I think, what is an interesting subject today. But before we get into that, of course, remember my live streams are always free. Don't send any money. Don't super chat or anything like that. Live streams are always free, but the fee for joining, if you could give the video a like for me, and if you're the type that, kind of makes me earn the like instead of just asking for it early on, if I do say something that resonates with you at some point today, hopefully by the end and you're ready to leave, that you have actually hit that like button. So up to you, but it is actually the best way to support the YouTube channel. The YouTube algorithm is a tough one, but that would be very appreciative. So got a few people joining here. One thing that I wanted to mention really quickly, let's actually just get started, but today's episode is actually going to be the first part of a longer series. Essentially what hey everybody, so please just allow me 1 minute. Okay, we had a little bit of a misfire right away. Screen share, I moved the screen share to a different place, so that was no fun. But essentially what we're doing today is the first part of what is a much longer course. I figured I want to go back right to the beginning, introduce the full portfolio, but instead of hitting people with, a 3-hour upfront video, I think we can split it up into little bite-sized pieces here, maybe 5-10 minutes each, and I can unpack everything so people can understand it and, absorb the information as it's coming. So, of course, we've got the strategies that we're going to be talking about, performance, that's always important, but also correlations, benchmark comparisons. I've got tons and tons of ideas. So we're just going to get through these every week, and hopefully by the end of it, everybody kind of understands my investing philosophy. But we're going to start today essentially with unpacking that, because my investing style is quite unique, and people probably are not used to seeing it like this. But there is actually a reason why I ended up doing what I do. And so I guess the best way that we can do this is start with what most other people are doing. And I just wanted to kind of illustrate why the vast majority of investors out there are actually disappointed with their investment results. So I am sure you've probably seen something like this before. You've seen these old standard pie charts that asset managers around the world are pushing their clientele through. It's maybe not necessarily these exact assets or these allocations, but you get the point. I'm sure you've seen them at some point. But these things actually don't work, and I'm going to explain why they don't work, but more importantly, they will never work. There's no reason why it would work. So the main thing that people could do if they wanted to default to the absolute baseline is what's called the VBanks, the Vanguard VBanks. So this is a 60% stocks, 40% bonds, balanced index fund, Vanguard product, very low fees. People could do this. Now, 8.24%. This is, of course, during I don't know if you'd say a raging bull market, but certainly a pretty strong bull market from 2012 up until today. Obviously, there's been a few hiccups, but 8%, it's never going to get any better than this. And to be honest, the long-term return, because of course it was down 37, 38% in the financial crisis, the long-term results are significantly worse than this. But this is the absolute best that it could ever be, basically, the 8% return. And there's other variations that people like to do. Other asset managers will try to throw their little spin on things, right? So we've got a baseline of what people could do in their own account. You could just dollar cost average into a balanced index fund, and you can probably expect a pretty low single-digit rate of return. Now, another thing, people might add some gold. They think, well, you've got some precious metals. Maybe that'll help a little bit. So a 50, 30, 20, is that any better? Well, no, not really. Within 1%, it's like 7 and a bit. And again, during a bull market. So expect significantly less. Hedge funds, HFRI Hedge Fund Composite Index. Of course, this is a combination of several different investing styles. Is this any better? Well, no, not really. So essentially the point, what I'm getting at is everybody's got their own little style, and everybody is trying to shift these assets around into different allocations and, different holding and stuff like that. Maybe this asset, they'll throw this one in. They'll tell you that commodities, that's the missing piece. Certainly you need some commodity action. So that's what's going on with these things. And essentially the expected return of all of these things is not going to be any better. There's different names. People call them, the Ray Dalio all-weather portfolio. You got the dragon portfolio, cockroach portfolio. I've heard the couch potato portfolio. Basically, it's just somebody taking their own spin. As I said, insert cool name portfolio. They're basically just shifting these things around slightly. And then it's up to the marketing teams to dive in there and explain to everybody why their allocation, their magic formula is going to suddenly be better than everybody else's. But the truth is that the discrepancy here is going to be, plus or minus 1%, because all you're doing is you're just taking a bunch of assets, you're putting them in a pile, and yeah, you can shift them around a little bit, but there's really no difference between all of these, and we can see that in the performance. So what is actually happening? Why is that? Because the marketing teams, they're not going to tell you this. They're going to say, no, this one's going to go up, and then this one's going to be hedging a little bit, stocks and bonds, inverse correlation. They're going to make it sound really cool. But the problem is that the baseline underlying assets, they all suffer the same thing. Now, all of them have good periods of performance. There's nothing wrong with the stock market during a bull market. In fact, I've always said that it's actually difficult to beat the stock market when it's raging higher. And certainly the last 10 years, it's actually been tough for a lot of people to keep up with the stock market. It's doing very well. But that's not always the case. Of course, it has had 50% drawdowns and more in the past, which can take 5 to 10 years to recover from. So you have to actually look at the entire landscape, because remember, this is the standard, 90% plus of the world is just investing in these buy and hold pie charts. And it doesn't really matter what combination you're doing, you're subject to the same issue. U.S. Treasuries, there are periods where they perform well, obviously, but there are also periods where they perform disastrously. This is the same thing as stocks. Can't hold it all the time. Gold. A lot of people think gold is the missing key piece, raging inflation or whatever. But gold can go 10 years without making any forward progress. And of course, you have to include the whole thing. Other assets, real estate, same thing. You get the point that sure, there's certain periods where it's doing great, but there are other periods where, what are we doing? We're just stuffing this thing in a portfolio, and what good is that? It's not really going to be doing anything. And this is really the crux of the issue, is that I'm sure you've heard it said many times before. Uh-oh, somebody just said there's no sound. I hope they're wrong. I can see the little sound bar moving, so I'm just going to keep going and just assume that it's just a single person. Oh, that would be a disaster, wouldn't it? Okay, well, I'm going to keep going because there's people here, and there'd be 0 people if there was no sound. So, but essentially the problem is that you've heard the saying that there's no such thing as free money. That's essentially what they're trying to convince people, is that there is free money for some reason. You just throw a bunch of assets in a big pile and hold them all together, and somehow that's going to produce some results. Well, why would that be the case? Why would that produce results? You've got a bunch of asset classes that have a long-term rate of return of anywhere from 2 to 3% on the low side, maybe 8 or 9% for equities on the high side. It doesn't really matter how you mix them all up. It's all going to kind of condense down to the middle, and you're going to get plus or minus 1% bouncing around that 6 or 7 range, right? That doesn't even include inflation. So, for some reason, a lot of people forget to factor in inflation. What if inflation is, according to the government, maybe 4.5% long term, but I think we can all agree that those numbers are a little fudged. If you're getting 6 or 7% return on your buy and hold pie chart, regardless of what it's called, the all-weather or the cockroach, it all sounds great, but you're not even outpacing inflation. And this is kind of why people get to the end of their investing horizon and they wonder, well, what's going on? This is basically the money that I just saved myself. There was no compounding. This magical compounding never really happened in their portfolio. Well, why is that? You're getting the same rate of return as the inflation rate. Again, why would you expect anything different? There's no such thing as free money. You can't just pile a bunch of stuff and say, look, it's going to produce something. Why would it, right? That's the point. So I guess the best way to say it, and I say this all the time, is If you want to beat the stock market, this seems rather obvious to me, but if you want to beat the stock market, you have to do something different than the stock market, don't you? There would be no reason why the vast majority of investors in the world are going to make forward progress basically doing no work. The investment world is not set up to help the client. It's set up brilliantly to help the asset manager. And, that's another thing that kind of the dirty little secret of the asset management world. The clients are getting basically no return when you back out inflation, but millions of asset managers around the world are making millions of dollars, right? They've got mansions and penthouses overlooking Central Park in New York or Chicago, Singapore, Zurich. They're all over the world making tons of money. Well, we've got a retirement crisis on our hands. The average person has about $250,000 in retirement. I don't know about you, but that's not going to stretch very far. So, and then you've got the statistics, half of people are living paycheck to paycheck. Well, asset managers are certainly doing fantastic. But again, why would you expect to beat the market if you're not doing something different? So this is where it comes to my work and why it looks so radically different. But the reason that we do it this way is, again, we have to decouple completely from the stock market and do something different if we want to beat it. And that doesn't mean we're going to beat it every single year, but long term, of course, if you track it, then you're tracking it. You have to actually decouple. So that's what we do. My portfolio is 4 independent strategies. And when I say independent, what I essentially mean is I don't take any trades in any one of them based on anything I've got going in the other one. So defensive rotation, traded independently on its own. I'll never take a position here because I've got a certain position here. These are all independently traded. And then when you put them together, that's the power of the portfolio. But individually on their own, and I do want to point out that these strategies, for example, our tactical volatility, these strategies do have individual courses. So this is the total portfolio course. Again, I'm building it out. You can see that there's a bunch of drafts here. But the tactical volatility course, there's lots of lessons filled in here. So VTS members, if you're interested in this, you can, join the community, and there's a course there ready to go. Iron Condors, there's also a full mega course already built out and attached. So when you join, even if you do the free trial, you get to see everything immediately. But essentially, the tactical volatility strategy, you could call this our flagship because I'm kind of the volatility guy. But this is a short volatility strategy. But of course, you can't just short volatility all the time. That would be as silly as expecting that you could just hold the S&P 500 all the time and expect to just, don't worry about the 56% drawdown in the financial crisis. Don't worry about the 50% in the dot-com bust that literally, inflation adjusted, took 15 years to recover from. People don't really realize that, but it took from 2000 to 2015 to just break even on an inflation adjusted basis. That's not good. So obviously you can't short volatility all the time. And so that's why we use our volatility metrics. This is our daily email, but I've built my own volatility index, and I essentially mine volatility data to be getting our trade signals. So we're checking a bunch of things about the VIX futures market, the cash VIX. All of these indicators together are what allows me to decide what the strategies are actually doing, right? So volatility, essentially it's circled around the volatility ETFs. Obviously, we want to short this. We don't use the VXX directly. We use the SVXY, but it's the same concept. Something that's down nearly 100%, obviously we want to short this thing. But we have to be smart about it. We have to have a middle ground of gold where it's kind of ambiguous. Gold is actually not a very good asset, to be honest, but there are times when it performs well, and it turns out the times that it does best is during that ambiguous mid to high volatility range. So we can hold it there and we don't get punished. And then, of course, long volatility, extremely important. There are times, it's very rare, we're only long volatility maybe 2 to 3% of the time, but there are times where you have to actually flip that switch and go long. So that's the tactical volatility. The defensive rotation is a NASDAQ-centered strategy. Essentially, the NASDAQ, at least in the last several years, has radically outperformed the S&P 500 or something like the MDY, the S&P 400. We've used something like that in the past for many years. But the NASDAQ is really performing very well, so we have exposure to that. But again, you can't just buy and hold this thing, otherwise you're going to take those massive drawdowns. The QQQ itself, just the NASDAQ, not even leveraged, was down 78% in the dot-com bust. You don't want that to happen to you. it will take 17 years to recover from that. So of course we have to cycle out into utilities and bonds and cash to make sure that we're only allocated during the high percentage times. So that's the second strategy. The third strategy, iron condors, this one is interesting because, again, most people's portfolios don't have anything in there that can profit unless the market is specifically going up. You know, you're holding all these assets, you need them to actually go up in order to profit. But an iron condor is interesting because it can actually profit from a lack of movement in the underlying. So we have to have exposure in our portfolio to make sure that we're always having something that can maybe make a little bit of profit, even if the stock market isn't going up. And don't let the options fool you. It's actually very easy. It's just a single click transaction. You can definitely learn iron condors. And again, reminder, there is a full course teaching every single aspect of iron condors. So anybody can keep up with that, I assure you. And then the last strategy is called our strategic tail risk for a reason. We need another strategy, not only to target different assets, but also to make sure that we have some long volatility exposure. Again, not very often, but when necessary, it can be invaluable. So for example, this is the 2008 crisis. The S&P 500 was down 56%. You can see the VIXM, which is a midterm futures volatility ETF that we use in the strategy. You can see it did quite well. And this would feel great, of course, if the market is melting down and your portfolio actually has something that's rocketing higher. That is very important. But the old buy and hold crowd, what are they going to do? Well, everything is correlated to equities, basically. In a crisis, everything kind of goes the same direction, and they're down, 40, 50%, whatever it is, and you got to wait several years to break even. I would rather be a little bit strategic with our strategies and avoid that from happening. So that's the portfolio. It kind of looks like a pie chart as well, but I assure you it's entirely different. These are independent strategies, each with their own built-in risk management. And of course, if you want to beat the market, you have to do something different than the market. That's the whole point, is that these people that are expecting to just throw something in the mix and miraculously come out on the other side beating the inflation rate, well, that would be considered free money, would it not? And I know, this is not popular among the asset manager crowd. I know a lot of people kind of throw shade on me when I mention this, but the truth is, it's not designed for the client, and it's designed to be very easy from a management perspective. Just kind of buy and hold, couple of irregular rebalances from time to time. You've got a team to onboard new clients. You've got people to help you do the basic stuff. Oftentimes, they're even just peddling the bank products. There's virtually no work on the asset manager end, and that's why you see a lot of them just parked in front of their Twitter all day long, just tweeting. I have no time to be on Twitter. I've been on Twitter for, 8, 9 years now. I've tweeted not that often, I think 9,000 times or something, and half those are just me posting my articles, videos, and live streams. So yeah, they've got a lot of time on their hands, and they're making a whole lot of money. So clients aren't, though. So there you go. That's the first little psychology of why I ended up being here with my investing style. It's just out of necessity. I have seen right from the beginning of my investment career that the status quo is the status quo for a reason. It works fantastically well for the traditional asset management people, but does not work at all for clients. So again, just quick reminder, there is a free trial to VTS. That's another thing too, little benefit to VTS. I don't think there's any asset managers that'll let you do a trial run of their business beforehand, but with me, it is as easy as just signing up for a free trial, no commitment. Click one button if you want to leave. If it's not for you, we'll part as friends, but there is a free trial on the website for anybody interested. So let me just fire really quickly through these questions. That was the first segment that I had planned on doing. How long did that take? Oh, that wasn't so bad. Start asking questions now. I will get to them later. I did have one mailbag thing that I thought interesting. Some people might actually be interested. Sometimes I get really interesting questions from people, and I think, oh yeah, maybe other people will want to listen to me ramble about that subject. So the second thing I'm going to talk about, the question that he asked me essentially was, how much time do I actually spend investing versus how much time do I actually spend just managing the business? So I gave it a lot of thought, and I tried to compartmentalize everything. And of course, these are all based on averages, right? I am a very regimented person, but it's not literally down to the minute. Sometimes I do use stopwatches on my timing, but you'll get the point. But I tried to do the best I could. So first thing we're going to talk about is basically the amount of time that I spend managing my portfolio. Let's say VTS did not exist. I had no followers, no clients, no nothing. How much time do I actually spend that I would have to do anyway, even if I didn't have a business? So the first thing is I spend about 5 minutes trading my portfolio. This probably surprises a few people, but our portfolio is very easy to follow. This is not active day trading. I spend about 5 minutes a day. Now, some days it might be 10 minutes. A lot of days it's 0 minutes. But yes, I basically don't even consider the actual trading when I, go into the trading software and I'm actually making trades. That is a very, very small portion of my time. So let's just ignore that. One thing that I do is every day I have to input the data for my spreadsheet. And again, this isn't for the community. This is for me. I need to be able to do this so I can manage my own portfolio. And what that looks like is I have some pretty extensive spreadsheets. Every day I'm just inputting all the data. I just go across the line. I input everything. And then I build my volatility barometer. I have to go through every one of these inputs to make sure that all my data is correct. And then when I get to the end, then all of that information is going to be able to spit out the trade signals that I'm taking. And again, this is my portfolio. So even if I had no clients, I still have to do this every day. And that takes about 1 hour. Now, just a little side tangent, because I know somebody's going to be saying, well, you can just automate that whole thing, right? And that's true. I could take that 1 hour and I could probably get it down to about 20 minutes, 15 minutes. But the thing is, and this is one of my trading edges, to be honest, is that because I input data manually, first of all, if you have a spreadsheet error, it's a nightmare if you've got an actual data feed going in. It's difficult to figure out where the problem is sometimes. So I just trust manual input more. But more importantly, I'm actually watching the trade signals every single day as they go, and I'm watching all the data being inputted every day, which means I'm identifying the trends as they're happening. I can see things. I can say, well, I remember from yesterday it was here and now it's kind of trending towards this direction. If you automate your data, yes, it saves you some time, but you're missing out on all of that good stuff that you're going to be noticing if you manually input everything. So yes, it does take me about an hour to do this. I do 30 minutes before I send my email, or 30 minutes before I decide my own trade signals, and then I do 30 minutes updating it at the very end of the day as well. So there's an hour spent there. I do 2 hours roughly of just basic research. I have to make sure that I'm always on my toes and making sure that I'm always testing things and researching ideas and tweaking my strategies and trying to improve things. This is not a set and forget type of thing. I'm not a day trader, and the business end of things that I present to my subscribers does seem to be easy to follow, but behind the scenes, of course, I'm doing a lot of work on my own every single day to make sure that I'm the best investor I can be and always staying ahead of where the market is going. So there's 2 hours there. About an hour a day, this is a little bit different. This is for my option strategies. So VTS is basically, like I said, 5 minutes, no time at all. But my option strategies, there is some time spent there. So I will trade about an hour a day. This is things like VIX options. There's quite a few trades to take there, and management here and there. The wheel of fun, earnings trades, diagonals, things like that, butterflies. I do a lot of volatility trading where it's different strategies. So I've got the volatility trend, the volatility step. These are using all different things. Pairs trading. I've got a lot of things going on with the option side of the thing. And so that's about an hour a day. I actually do spend a lot more time option trading than just straight up ETF stuff. And then about 2 hours a day, again, I have to make sure all of that is on my toes. So all in all, 6 hours, 7 days a week. I have no days off. I have basically what amounts to a full-time job, 42 hours. So it's not so bad. It takes me about 40 hours a week to manage my own portfolio. And that's if I had no business at all. If I had no clients, nothing. So if I wanted, I could shut everything down at VTS. And even though I've always said it's a terrible idea to trade your own account and withdraw money every month, it is a terrible idea. Don't do that. Always make sure you have a side income. I've got videos on YouTube talking about why. But I kind of have reached that escape velocity where if I wanted, I could shut things down. And obviously my lifestyle would get toned back a little bit, but I could do that. And technically I could get my work and my life to just 40 hours a week working for myself and no more VTS community. So I could do that. But here's where things get busy for me, because this is what it takes to manage the actual business of VTS. And this is stuff, like I said, that is only in existence in my life because I'm managing a community, right? So everything that is involved in managing VTS. 2 hours a day answering emails. This is, no offense to everybody, but this is the least favorite part of my day. And it used to be, at times 4 or 5, even 6 hours, but I've got a pretty good handle on things. It's about 2 hours a day. I'll get back to this in a little bit, but 2 hours a day making videos, right? This is another reason why I just can't release that much content because I just don't have the time, but it takes a long time to make videos. You got to write the script, shoot it, edit it, upload it, do all the tags, the YouTube stuff. It's actually very difficult and time consuming. So this is, again, another side tangent, but one of the biggest dangers that people fall into in this social media world is the people that they end up following, the courses that they buy, the asset managers or the subscription services that they are following. You have to be extremely clear. Are you following somebody who's a good investor, or are you following somebody who's good at social media, who's a good content creator? Because I know for me, I am so busy managing my portfolio, I don't have time to be on Twitter all day long. I don't have time to be doing 4 or 5 videos a week and a bunch of content, really polished and all this stuff. That's not part of my job. I'm an investor. I'm not a content creator. I'm not a YouTuber, right? So you got to be very careful who you follow. There are a lot of people who have 10 or 20 times as many followers as I do that I can tell you right away, they don't know the first thing about investing. They've got a year of experience. Their strategies are all like, I can see the red flags all over the place. They're going to fail, but they're extremely good content creators because they can spend all day long doing that because that's all they do. So again, side note, but you have to be very careful who you follow online. The people that you're following who are actually working hard and investing, they really shouldn't have super polished YouTube content and just massive streams of new stuff. It's actually extremely time consuming. So 2 hours a day there for me. 1 hour a day writing articles. So I talked about this last week, but I actually do write a lot of articles for the website as well. They take less time because it's just coming from stuff I already know in my head, but about an hour a day there. And then an hour a day preparing and sending the email. So again, this is just like taking pictures of these and copy and paste and making sure the email looks good, put all the blog articles in the right place, maybe add a clip or something, do the YouTube tags. So preparing the actual email, of course I have to do all the volatility metrics as well. So that's about an hour. And then 2 hours a day building the VTS Options Academy. So this is something that's new, put it in a different color because it's not actually part of my main day. But in the last several months, I've been doing an extra couple of hours at night trying to rebuild the VTS Options community. Because we used to have two. We used to have the VTS and the VTS Options. Both were very popular, but kind of victim of my own success. My following has grown. My email nightmare has multiplied by many times. And I just didn't have the bandwidth to manage both communities anymore. So had to choose one. Now that I'm getting a little bit better handle on the email, I have a few ideas to streamline a few other things. I should be able to get the maximum value for people, bringing back 2 communities. But again, incredibly time consuming. This is a lot of videos, a lot of live streams. Again, the person that you're following shouldn't have time to just fire that stuff out in a month. You should probably be doing a lot of investing outside of just making YouTube content, right? So again, it's taking a while. But again, there's 6 to 8 hours. It's 8 recently, but basically 6 mandatory all the time. So VTS itself is another full-time job for me. So this is where I kind of get into trouble. A lot of times, because I am a workaholic, and I used to really wear that as a badge of honor like 10 years ago. But these days I'm starting to think, well, I'm working 80 hours a week doing this business. I basically work 7 days a week. I don't have much of a life. So I would like to actually try to find a few ways to streamline things and maybe not only just try to enjoy life a little bit, but also release more VTS options content and get that going again. So I've got a few ideas, kind of run this past. I actually had a meeting with, met up at Starbucks with a subscriber. It was great. We talked for several hours, actually. It was a good time. I think I kept him even a little bit too long. I think he was late picking up his kids or something. But anyway, I took up several hours of his day. We were just chatting. And one of the things that he kind of recommended to me is that there's a few things that I could do to finally streamline this, because I've been a one-man show basically the whole time, which works fine for me. I tend not to play well with others anyway. I'm kind of a perfectionist, but there are a few things I could do. I could hire a video editor. That would free up a lot of time for me. Probably put out an extra video a week if I did that. The other thing is I could hire somebody to do my social media. Like I said, I just simply don't have time to be a social media guy where I'm always commenting and people scrolling and I'm having conversations. I just do quick drive-by, post a clip, post a video, and I get back to work. So if I hired somebody for maybe 30 minutes a day to just post my stuff, then I could probably get rid of social media altogether, which would be fantastic, because I think it's a nightmare for people's mental health. But anyway, the big thing would be free up email burden. So one of the ideas that this guy had when we were talking at Starbucks is he basically said I should just scrap email entirely, find a submission form, and basically everybody funnels their comments or their questions through the submission form, and I should just start answering them on camera and then pre-recorded. And then I could just upload those. I could put maybe 10 of them together, the most interesting questions, and I can timestamp it all because it's done ahead of time. So it's actually a pretty good idea. I might actually experiment with that. So just fair warning, things might look a little bit different, but if I could get a bunch of good questions answered, timestamp them all, and get a piece of content out there, I think I'm killing several birds with one stone there. So it was actually a really good idea, and I'm going to try to do it. So that's essentially where I'm at. Anybody who's wondering what I do with my time, that's it. Basically, normal full-time job. I think most people work about 40 hours a week, give or take. Now, I don't have a boss, so I'm not one of those that's trying to look busy. I actually do the 40 hours a week. I don't have to stay late to try to impress the boss. I actually just work the 40 hours. And then I got another 40 hours of VTS stuff, which is fine. No complaints. I actually enjoy it. And it's a challenge, and I like that. So, but then again, life is meant to be lived, and I would like to golf a few times a year. And another thing too, just kind of off topic, but recently my Twitter or my Instagram has been showing me skiing stuff. And I used to be a skier when I was younger. I was actually pretty good. I was actually considering competing, but I haven't been on skis in 30 years, right? I stopped, I think, when I was 18 years old. So it's been over 30 years since I've been on skis. I'm kind of considering maybe getting back into it. So for me, I live in Dubai, as most of you know, and it's actually really convenient to just go to Switzerland, go to France. There's flights are less than $1,000. It's very, very convenient, just airport to airport. Traveling to Europe from Dubai is super easy. Lift passes in Europe, I've checked it out. They're less than $100, 70, 80 euro. And there's some good places, Zermatt, St. Moritz, you got Davos. And then in France, you've got things like Val d'Isère and Val Thorens, I think it's called, or Courchevel. They're all kind of really close and convenient for me. So skiing is calling my name. I don't know if I'm going to get to that, but if anybody in the community or anybody watching is actually a decent skier, shoot me an email. Maybe we'll meet up sometime. I'm going to need some ski buddies because my wife has never skied in her life. So I think what we're going to do is there's a ClubMed in Val d'Isère in France. I think we're going to go to the ClubMed because they get free lessons and maybe, all inclusive. You don't have to worry about meals, ski in, ski out. Should be pretty cool. And then from there, I don't know. I'm either skiing with her or I'm skiing alone, and I might need some friends. So got to free up some time with this VTS stuff, though. So don't want to sound like I'm complaining, but if you were interested in what I do for a living, it's about 50-50 split. Half of it I have to do. Half of it I would do myself. The other half is business stuff, which is also very fun. Managing your own business is cool. I would recommend other people give it a shot if you haven't. All right, so question time. Let's try to get through a few of these. Another thing we talked about at the meeting with Starbucks, he did mention it does get a little bit frustrating when I don't answer your questions. And I explained to him that I'm using a software called Ecamm, and it just doesn't show them all to me. So just as an example, I'll get to this question, but I'm just going to flash it. For an example, the reason I use Ecamm is because you can see his question. I can click it and you can see it, and it kind of looks pretty cool, but it doesn't show me all the questions. So one thing that I could do is I could actually go over to the YouTube channel and watch it here. And then all of these questions, oftentimes there's questions in here that people are asking on YouTube that I don't get to see. So it is unfortunate, but I've essentially chosen the cool look visually where I can flash someone's name. So I'm going to do that one more time, but he did give me a few ideas where I might be able to figure it out. There's something going on. I'm tech illiterate, but there's some reason why I'm not getting all of them. I'll figure it out. So the SVIX is used, if used properly, it's like printing money, but with leveraged ETFs like SOXL and TQQQ are perfect to work with SVIX. Is that just a comment? So again, it feels like there should be a follow-up there, but on my end, there's no more follow-ups. So if that's just a general statement, I would say be careful with that first part where you said it's like printing money. You're probably suffering from a little bit of recency bias, to be honest, because there are going to be many years where you don't think shorting volatility is printing money. In fact, you think that, wow, is this even worth doing? It's so difficult. But yes, obviously in the last, we'll call it a year, obviously in the last year, yeah, for the most part, shorting volatility has been very easy. But the same could be said about trading the stock market, right? It's been actually fairly easy the other way. But I would definitely caution you about thinking that it's printing money, because you absolutely have to have a very complex strategy to cycle in and out. Again, getting back to the buy and hold stuff, you can't just short volatility all the time. You're going to blow up your account. If you're direct short with unlimited loss, you will literally blow up your account because it'll go up hundreds of % against you, unlimited loss. And if you're using the inverse products like SVIX, which you mentioned, you won't blow up your account completely, but it does have a buy and hold drawdown of 96%. So you don't want to lose 96% of your capital every few years. I don't think that's a very good plan either. So it's not printing money, but I'm glad that you're having success with it lately. I have a clip that I uploaded, or have I uploaded? It's either today or tomorrow on the Clips channel, talking about this, that the absolute best time to scrutinize your trading strategy and do some stress testing is when it's working really well, because that's when people fall asleep. They think what they're doing is easy. They're suffering from recency bias. And then the market does something unexpected, and they realize after the fact, oh, wow, I had 3 blind spots I didn't realize, and yeah, that lost all my money again. So you don't want to do that. I would say if you're having success, that's awesome. Love when people make money, but I would scrutinize what you're doing and make sure that there's an actual edge there rather than just an advantageous market period recently. Because, look, I've been doing this for 18 years, and speaking to a few other people in the industry who are volatility guys, you just don't get people with experience say that shorting volatility is easy money, it falls from the sky, it's printing money. They don't talk that way because, we've been through the ringer, we've been through all these periods, and we know better. It's actually extremely difficult. There's very few people who can pull it off. And long term, when stretched out, virtually everybody has a difficult time with it. So I would strongly caution. I don't want to throw water on your party, though. Good for you that you're doing well. In general, what are the pros and cons of using CFD instead of direct ETF or stock replacement? For example, in tail risk strategy, when your signal is on VIXM mode, I could buy a half position in CFDs. So you could, and when I was talking, there's an article on the website and also a stock replacement course. When we are trying to find solutions for Europeans who can't directly trade the ETFs, the US-based ETFs, just because of all those KID documents and the MiFID II regulations and all that stuff. So one of the options, I prefer options, but CFDs is actually a way to do that as well. If you're not one of those people, like if you're not doing it for a specific reason, I would say don't bother. But if you have to do it, then yes, it's actually not overly difficult. There's an article on the website you should read because there is one section where I talked about it. There's a couple of drawbacks, but you should be fine. That's one of those things, though, I don't talk about it in the community at all. So you're kind of on your own if you're doing that. You got a large community. We've got people from 70 countries around the world. I have to be careful what I speak about because most people don't like complexity. So I don't even talk about futures. I only talk about the majority ETFs and occasionally options, but I don't talk about futures, and I certainly don't want to introduce any conversations about that. Even though it's actually pretty simple, you'd be, people start falling off pretty quickly when you hit them with stuff that they don't need to hear about. So anything that you hear me talk about in the emails, you're never going to hear discussions on that. You're kind of on your own. Okay. Oh, here's another one. Is this the follow-up? Look at the S&P volume back in the 2000s in the last 10 years. It's like the market volume is on mute the last 10 years because of buy and hold asset managers have gone to sleep. That's not something that I've really tracked, but that's interesting. I could look into that. Yeah, sometimes when I speak about that, I am just telling the truth that this is an industry set up entirely for the benefit of the asset managers. There's virtually an afterthought for the clients. But at the same time, why would it be any other way, right? We have to be pragmatic about this. And if you were an asset manager who could, you're trying to build your career, and you could, if you wanted, just plug into an existing system and just do the whole buy and hold stuff, maybe have a little bit of personal spin on how you do your marketing, and you're going to have success doing that, right? This pie chart buy and hold stuff, I mean, it's everywhere. It is not difficult to get clients who already have been introduced to that. It makes sense to them. You sit them down and you tell them, okay, we're going to do stocks here because of your age, and 50% because stocks do the best, but hey, we got to watch out for those drawdowns. So we're going to introduce some bonds over here, and bonds have an inverse correlation. And don't forget precious metals. They did well in the financial crisis. So we got to have a little bit of that. And then we want some exposure to commodities and real estate. I mean, I basically just sold it right there. So you can plug into that system and you can make hundreds of thousands, if not millions of dollars as an asset manager doing very little work. Or you can think completely outside the box. You can put yourself on the line. You can put your reputation on the line. You can, that meme where the warrior, I think it's actually Jon Snow from Game of Thrones. He draws his sword, and in the distance there's an army of 1,000 people, and it's him against the army. You can be that guy if you want, like I am. I'm fighting the system constantly. I'm doing something that very few people do, if anybody, to be honest. I haven't seen anybody really, in this specific area that I'm doing. You can be that guy, but it's tough. It's a real slog, and most of them fall away. And it actually requires real investing skill. But you can just go for a few months and you can get certified. You can get your series, whatever they call them. You can get registered very quickly, and you don't even have to be a good investor. You can just use the bank's prepackaged pie charts and you can peddle those. So yeah, on the one hand, it's terrible, and the clients are definitely going to fail if they continue to do this. And what's weird is the clients actually just keep trying. They actually agree. They're like, no, okay, that one didn't work, but I like what that guy's doing over there. I like the 35% and the 40%, and let's go argue on Reddit. No, you should have 20% treasuries, and you should have a little bit of emerging markets. That's the missing piece. People do this all the time, and 20 years later, you realize, oh, yeah, it was just the asset managers having a very simple, streamlined process to making big money. Tempting. A lot of people do it, and I've chosen not to, of course, but I don't blame them. It's actually pretty easy living. If you're an asset manager who's just halfway decent at marketing, it's pretty easy living, pretty easy job. It's hard to fault them for actually choosing that. And look, nobody's ever going to say it publicly. They're never actually going to share the discrepancy, but I strongly feel that their personal private portfolio probably looks substantially different from the public one that their clients are investing in. I have a very hard time believing that 90% of asset managers out there are following the same pie chart that their clients are in. I feel like they're better investors than that. I think a lot of them, their performance sucks. We know that 90% underperform the market, blah, blah, blah. We've heard this. But I suspect there's a lot of pretty knowledgeable asset managers that if in their own private account, they kind of know what they're doing. So it is what it is. I'm on the outside looking in, so I can shine a light on these types of things, and hopefully a few people wake up before they lose 20 years of their investing time horizon. Because you don't have forever. You've got to figure this stuff out, and you got to find a system that works and stick to it long term. You don't have 20 years to waste on JP Morgan's system that failed, that pie chart didn't work, but I bet you Morgan Stanley's is better. No, it's not. Ray Dalio's is the same as the cockroach, the dragon, the couch potato. They're all exactly the same. Okay, you go on long volatility with one strategy and short it with the other. Wouldn't it be simpler for these two to cancel each other out? Well, they'll never be both at the same time, right? I don't know if that part was a little bit muddy when I was explaining it, but just because of the way the volatility metrics work, yeah, there's no way that we're ever going to be short volatility here and for some reason long volatility over here. It doesn't work that way. So essentially, you don't want your safety position to be the same position. So the first layer of diversification in our strategy is that they're all getting signals from different places and they are independent. But the second layer is that they're moving towards different assets. So gold, long vol, utilities, cash, sometimes real estate, sometimes bonds, and a little bit more long vol. Iron condors, market neutral, they do better in a market crash than they do markets climbing, right? Right now, I did a video on that as well recently. But no, to answer your question, it's never going to happen at the same time. That would be silly because the volatility ETFs themselves are derived basically from the same products. So if you're short volatility and long volatility, it is literally the counter position. You would never do that, right? You just reduce one of them and eliminate the other. It wouldn't make any sense. So yeah, good question. It's never going to overlap like that. But there are plenty of times we'll be in long vol and cash and bonds and gold, or we'll be in short vol and a little bit of bonds and cash. Those things can overlap. But short vol and long vol, yeah, what's the point? They're both trading the front month VIX futures. Why would you take literal mathematical opposite positions? It wouldn't make sense. Okay. VIX options. What is your VIX strategy? I've been doing a broken wing butterfly for a debit when it's low volatility. I don't want to get into it. You know that. It's going to require some work. I mentioned it before. I have to be very careful what I say because you don't want to introduce complexity to a community that doesn't want to hear complexity. I know you do, but most other people don't. And secondly, introducing stuff just like a quick little drive-by when it's actually a strategy that you have to do correctly, it can do more harm than good, right? If I gave you a 3-minute, Cliff's Notes, back of the book summary explanation, it might get people into more trouble than they asked for. Did I do that wrong? My email said 12 p.m. Eastern time. Isn't that when I started? I started at 9 Dubai time. No, I didn't. I did get that wrong. It's 8:50. It's 11:50 Eastern time right now. I did get that wrong. I started at 11 a.m. Eastern time. What did I say, 12? So does that mean people are going to be coming in late? I apologize for that. I did get that wrong. Oops. Well, the rebroadcast still plays, and it's kind of all the same. But I'll stick around for a few minutes and answer any, clean up the rest of the questions. Does the market move when VTS puts out a trade? No. We don't have that kind of volume. We've got, I don't even know. I don't ask personal information about people's accounts, so I would only be guessing. You have a large community with a lot of subscribers, but I would imagine, and it's, again, total random guess, but I would imagine that most VTS members are kind of in the 50,000 to 500,000 kind of range. So it's not like we're trying to push through $500 million into these things. Plus, the vast majority of what we do are ETFs that, you'd have to be you'd have to be Ray Dalio to be pushing the market, right? We're talking about ETFs that are massively liquid, right? So those three, no problem. These three, no problem. And you might think, oh, VXZ, that's kind of lower. Maybe it's in the 50 to 80 million range. But the truth is the only time we're ever going to be using the VXZ is when the market is crashing and we're going long vol. And that's when the volume on that product ramps up even further. So even though right now, if you looked at the volume, it's not that high, when we're specifically trading it, it's higher. Plus, you have to factor in that volatility ETFs don't work the same way as regular ETFs, right? The volume means a lot less, and we're essentially trading based on the volume in the VIX futures market because there are APs that can, create and redeem shares, and it just functions a little differently. So even though some people think the volume is slightly low there, it's actually totally functional. Same thing here. We can't move the SPY. Iron condors, you might think so, but the only ones that we ever actually use, I'm sure there's a lesson in the Iron Condor course talking about this, but we basically only use large ETFs, right? The biggest volumes, SPY, the Qs, sometimes TLT, but we're talking about the most liquid options market. So no, I can't move the market, and certainly nobody can really move the market on those ETFs. Options trading is a little bit different. I mean, a lot of those option communities that you see out there, the reason that they trade such small, obscure names is because of that. Is they can front run the community and it actually can make a significant difference in performance. But we only trade things that there's no possible way, even if I did front run, which I don't, I send the signals before I take them myself. So the community gets access to the trades before I do. Still, what am I going to do? Move the SPY? It doesn't work that way. A VTS fund might work. It would work fantastic. One of the things that I would love to do is launch an ETF based on my total portfolio solution. The problem is I don't have the capital for that, right? The fees alone are going to be several $100,000 a year at least. Probably to run an ETF based on my portfolio would probably cost, $300,000 or something like that a year. And then you also have to seed the ETF itself with multiple millions. So I'm just not in a position capital-wise to be able to do that. Perhaps down the road, and certainly if I partnered with other people, that might be on the horizon, down the road. I don't know how long, but it would require partnerships too, because even though I'm a fully certified, you would say, asset manager in Canada, I have all the letters behind my name, and I did all of that. I'm not just a subscription guy. I was fully certified asset manager, but I chose to just not be registered and do the global subscription service. If you're an asset manager, you have to manage capital for only people in your jurisdiction. So basically, I'd be managing capital for people who live in the greater Vancouver area, or do what I do. My style is a community of people from 70 countries around the world, and I chose that. So if I did do an ETF, it actually would require partnerships with registered advisors, which would be easy enough, but the capital is really the hang up. I just don't have it. Oh, this is a good one. I can answer this super quick. How is it possible that 2003 performance strategy was 80, 220, 1% to 2%, and the total portfolio is 20? The reason is because we didn't start our tactical volatility strategy until August. So what you're looking at is missing about 8 months of that number. So it's never going to add up. And you got to remember too that our portfolio doesn't always trade a set allocations and set strategies. We've actually got 7 or 8 that have come and gone from the portfolio based on when they're most suited for the portfolio. So essentially the tactical volatility was removed in February 2022, I believe. And because I removed it, we actually avoided a pretty big drawdown. It drew down about 30% in 2022 in the spreadsheet itself. But the VTS community didn't suffer that. But then also in 2023, where's my thing? It was up substantially, but the VTS community only joined in the last 5 months or 4 months, something like that. So that's why if you just look at the spreadsheet numbers and add them all up, it's never going to be fully matched up. You have to actually know live results, which strategy was in the portfolio, in what allocation. And of course, I keep track of all of that, but it changes over time. And I really do it down to the day for the official live performance. Like I think we removed tactical volatility on February 9th or something like that. And I will actually go in 9 days in, get the live results, stop, substitute the new strategy in. The live results that you see at VTS are literally exactly what happened in the portfolio. So when you look at this number, this is the live results that went out to the real paying community in all the exact allocations. There's no survivorship bias, no backfill bias. This is the live results. But when you look at individual strategy performance, like this one, for example, for this video, I was showing the spreadsheet for the strategy. So some of this wasn't live trading. And as I showed in the tactical volatility lessons, the live results our live results are actually significantly better. I don't know if I can log into that. No, that's not going to show me. Our live results are actually about 10% better than that spreadsheet. But when I'm making videos, it's just easier to show the spreadsheet because then I can adjust things and I can show people, oh, this is easily what would have happened in bonds. This is what happened in 2008. Even though it launched in 2012, I can make those really quick adjustments if I'm using a spreadsheet. But our live results were better than that spreadsheet. But in 2023, we didn't actually restart until midway through the year. That's why. ClubMed is more family resort. Their special one, not family friendly. You will have more fun there. I did research that. And so as far as ClubMed ski vacations, there's several. So there's Niseko in Japan, which is a good ski place. There's St. Moritz has one, which St. Moritz is incredible. And I miss Switzerland a lot. Yeah, St. Moritz is awesome. But those ones, and then there's Val Thorens in France. I don't know if Verbier has one, but there's several Club Meds that have skiing. But the Val d'Isère specifically is the one that everybody says it's kind of the luxury one. It's the only one that they call the exclusive Club Med. It's more expensive, but apparently it's pretty awesome. So that's why I specifically chose that one. I'm kind of with you. Club Med is awesome if you have kids. I think the people look after your kids and you can just duck off and go skiing by yourself. But no, I've researched the Val d'Isère Club Med is definitely different and worth going to. I answered this before. I don't talk about futures. There's no reason to talk about things within our community that, A, we don't trade in any of our portfolio anyway. We don't trade any futures. And secondly, 95% of people are just not interested in it. So, bro, Couch Potato is a market wizard. Not exactly sure the point there. The Couch Potato portfolio itself, I believe, makes about 5% a year, long-term CAGR. I don't know if that's a market wizard. Hello? It's 8:50 California time. Yeah, I definitely screwed that up. I went an hour early. I tried to go at noon, but Elon, oh, come on. Zuckerberg would annihilate Elon Musk in a UFC fight. That's not even competitive. Elon Musk made a catastrophic error dragging this out further. If he would have done it the second those two decided to do it or started talking about it, Zuckerberg versus Elon Musk in the UFC, if they would have done that right away, Elon's size perhaps might have, he had some chance. But, you know, say what you want about Zuckerberg and Facebook, and I hate Facebook. I just can't stand that thing. But Zuckerberg is one of those guys, and I've been saying it right from the very beginning, like, don't sleep on Jake Paul. People like that who have millions and millions of dollars, and in Zuckerberg's case, billions, and they choose to go fight. You got to be a little bit careful for these people. They're wired a little bit differently. Like Jake Paul and Mark Zuckerberg, they are training with world-class trainers, world-class fighters. Zuckerberg's rolling with, black belts every single day. I just saw a thing on Twitter now. He's in Japan. He's making a katana sword. I'm as against Facebook and Zuckerberg as the next guy, but he's kind of living the dream of a billionaire, and he's serious about it. He's a decent fighter. I know people don't want to believe that. Same with Jake Paul. Like, he's not going to beat any actual world champion boxers, but the guy's legit. He trained hard, and he trained with the right people. And I said from the very beginning, he's going to mop the floor with these former UFC fighters. And that's what we've been seeing so far. So yeah, Zuckerberg all day long. They're not going to do it, of course. It's a complete mismatch at this point. But Elon Musk should have done it day one. I think that would have been interesting. All right. Are there any more? Well, skipped my question. So here's what I'm going to do. I'm going to go live. I'm going to look at the YouTube, and I'm going to find questions from you, because I know people find this incredibly frustrating. My eCam software is so easy to use for a Mac, but it doesn't show everything. So let me see. Question, I'm late. You said 12. That's the same. Okay, this is weird. It all looks the same right now. Well, my question was, okay, so I'll show you, just so people don't think I'm messing with you. You tell me, I don't know, can you see this? I have it on live chat, so there's two things. It can either be top chat, and you said right here your question was skipped, so we're looking for you. There it is. That's your question, right there. Do you switch between currencies? Is that your question? Because if I skip over to live chat, your question's not there. Yes, it is there. Top chat. So that's what I mean. Your question is skipped on my software. So I just have to read it out loud. Let me just go back to here, and I'll just read your question. It says, do you switch between currencies? For example, I'm a Canadian, so when I see the USD is high, 135 or more, I convert to Canadian. Do you think it's noise, or if it's better to only hold USD? So for me personally, I do nothing with currencies because it's adding a secondary element that I personally don't think people can time, right? With investing, of course, you want to be as complex as you need to be to achieve your goals, but you don't want to add complexity simply to be complex. So let's say the USD to Canadian dollar does hit 135 or more. You'd think, well, historically speaking, it might level out and go the other way, but that would just be adding another element of randomness to my strategies. So I have all my money in US dollars all the time, no currency hedging, no currency switching. I am Canadian, so not a resident. I haven't been a resident in 24 years or something, but all my money's in US dollars, and I can't tell you not to. There are a lot of people who do worry about this, and I think with Canada, it's a little bit less pronounced, but if you're talking about certain European currencies, yeah, it can matter. But how are you going to control for those variables? I'm not a macro guy. I'm not a currency guy. I don't really follow it enough to make any conviction statements that, okay, now's the time we should convert our capital and go the other way. I just can't do that, so. Okay, so now your question surfaced at the very bottom of the feed. So is that you? You copied and pasted it and you did it again and now it showed it to me? I know, it's very frustrating. I don't know why eCam skips questions. And originally I thought, oh, it's skipping them because there's a difference between live chat and the top chat. But that's not it either. And I thought, oh, well, maybe it's filtering for what it thinks is spam. But that's not it either, because the ones that are being skipped, yours even says Q and then the question. Sorry. What I just did, reading the question out loud, I could do that. But for some reason, I just think that this looks so much cooler. And I think certainly when I'm trying to cut them all and maybe fire a few of these off on the Clips channel, this just looks really cool. So, Michael, is there a specific market situation where someone would consider UVXY versus SVXY? Well, that's an interesting question. So they're opposite, of course. UVXY is 1.5 times long volatility, and SVXY is 0.5 times short volatility. So yes, there would be times when you would want to differentiate between long and short. Clearly, we are majority of the time, obviously, we're going to be short volatility. I think roughly 66% of the time we're short vol. Roughly 3% of the time we're long vol. And then the remainder is going to be here. What is that? Quick math, 31, something like that. Don't yell at me if that's wrong. Into the gold when we're ambiguous and there's no solid trend in either direction. So yeah, obviously there's times when you want to be short and when you want to be long. The two that you chose makes your question interesting. So I think you have to be more specific because you're talking about not only are they actual inverse products of each other, but the leverage is 3 times different as well. So yeah, they're just absolutely not comparable. All right, so I'll just sit here because I know I told everybody the wrong time. And I can see actually the number of people watching. There's more people watching now than there was when I started. That is my fault. I apparently can't tell the time. Let me go over to the YouTube and see if there's a couple that stand out. Do you switch? Is there a specific situation? Well, I think I got them all. So unless there's more pressing questions from anyone, hopefully nobody's too upset about all the possibly terrible things I said about the asset management world, but it is the truth. Unfortunately, when you pile up a bunch of assets in a portfolio and each one of them on their own make anywhere from 3 to 8 or 9%, and you just mix them up, well, guess what's going to happen? Your long-term rate of return is going to average out to something like 6 to 7%, and that is largely going to be eaten up by inflation and fees. So there you go. That's why the average investor sucks, because they're being told to do something because it makes the bank money, makes the asset manager money, it makes the RIA money. Some of the biggest names on Twitter, some of the absolute biggest accounts that you think that guy is an absolute killer in the asset management world. Well, their performance sure isn't. So if you care about performance, then don't even consider. If somebody ever even remotely implies that you should do anything even adjacent to something that looks like this, you just turn it off. That's just it. They're done. They're just funneling you into some type of product that kicks back some really sweet fees for not doing a whole lot of work. That's what that means. You see this picture, you go the other way. That is a good rule of thumb. Like I said, if you want to beat the market, you have to do something different than the market. So there you go. We get notification from YouTube when you set it up. That's true, but a lot of people probably, because I shot it out through an email as well, probably people, well, this might be presumptuous to think people set their watch to my live stream, but people who are expecting to see me at a certain time, they probably missed it by an hour today. So that is definitely my fault. Did you make some research about post-earnings drift with options? Well, my option style is actually different than what you have probably gotten used to seeing online. So where's my YouTube channel? There's one video that you can see. I basically kind of summed it all up. Nope, not that one. It's called Long Earnings Plays. Let me see. Long straddle. Basically what you've seen. Where is it? Oh, it's on the Clips channel. Yeah, go to my Clips channel and use the search function and search for long straddle. And essentially what I do is the exact opposite. What you've probably heard other people do, and all those people who teach courses, they kind of just regurgitate the same thing. They're either selling straddles or selling iron condors, typically before the earnings announcement. They think that because there's a volatility ramp into earnings, that if you sell the juicy premium after the earnings come out, typically whether it's up or down, whether it's good news or bad news, there's going to be some volatility crush, and they're telling you that you're going to capitalize on that. And largely, yeah, most of the time it's or at least some of the time it's like that. But the problem is that there's also some pretty big shock moves, and you're also net short Vega in an unknown event. So what we do is kind of the opposite. We go maybe, let's say just on average about 14 days out, you would buy volatility either through a long straddle or under certain conditions, maybe a calendar. And then there is that expected volatility ramp when you're going into an unknown event. But what I actually tend to do is, or always 100% of the time, sell it before the earnings. So same day, maybe the day before, and that's actually where you make your profit. The benefit there is that because you're long volatility, presumably opened during reasonably low volatility to begin with, you can actually maintain the trade for a while, right? Make sure that the expiration for the contract is also another week after the earnings event, so you're not getting that theta decay very much. And then if the market happens to dump, or if there's a big move in that 2-week period, you get two benefits. You get the boost of the volatility, plus you get the boost of the actual delta moving the option around. So that's how we do it. We just flip it upside down. And I don't understand why, but nobody talks about that. But that is the best way to trade earnings. So you said post-earnings. There's no post-earnings for me. 100 grand to Elon. You seriously think Elon Musk is one of the least athletic people, like visually. Of course, I have no proof of this, but just visually, are you serious? You think Elon Musk can take somebody who actually trains with world-class, and he's an athlete. I mean, we've seen him doing other sports. He's not bad, right? You get a younger, much more athletic, driven guy who's training versus Elon. Like, no hate on Elon. I mean, he's obviously richest man in the world. He's doing something right, but an athlete he is not. So, yeah, I would, I think Zuck would mop the floor with him at this point. Like I said, 2 years ago, I'd say 90% sure Zuck finishes him in 2 minutes. Now it'd be quick, it'd be very, very quick. I think people actually radically underestimate the power of jiu-jitsu as well. So I'm not claiming to be anything. I'd probably be equivalent to like a blue belt or something, just a little bit of training. But you'd be amazed what some training at the level that Zuck has done, how much of a bigger guy who's untrained you can actually tap and just have your way with. It would be comical. So people just don't get it. They think, well, the size difference. No, jiu-jitsu's not like that. He can definitely give up 50 pounds and easily beat somebody who's untrained. No problem at all. Sorry, I meant UVXY. Okay, that makes more sense. Before you asked about SVXY. Yeah. Okay. And then you're asking, are there times to, well, I would say, and this is what I always tell people, that absolutely everything in the volatility space can be traded just as effectively with either VXX or VXX options. So unless you have some specific purpose for using UVXY, don't, right? People don't understand how leveraged it is. If you look at the beta of UVXY to the S&P 500, you're talking about anywhere between 4 and 5, depending on the time period. Would you ever mess around? Like if, maybe your answer is going to be yes, but if for some reason the S&P 500, instead of the SSO at 2 times or the U Pro at 3 times, there was a 5 times S&P, would you short that thing? Would there ever be a circumstance where you would short the 5 times S&P 500 product? No, right? That's just insane. Everybody would know on its face that that's a stupid thing to do. But when you call it UVXY, people buy that thing all the time. Well, you're trying to thread a tiny little needle, right? It's just a terribly low probability trade on something that has a beta factor of like 4 to 5 times the S&P 500. You are asking for trouble. You're going to bleed capital insane amount. And then on the flip side, if you're talking about shorting them, again, the UVXY in a bad period, if you didn't cycle out into safety, it has already gone up, 1,500% in the pandemic. It can go up way more than that. It could go up 2,000% on you. So let's say you shorted UVXY with 5% of your account, and the other 95% was in, dividend aristocrats, just safe stuff. That 5%, if you didn't cycle out and you just buy and hold, your entire money, all your money's gone. All your dividend stocks are gone. That 5% wiped out 95% of the rest of your portfolio. That's what happens. So on either side, whether you're talking about long, no, you cannot thread that needle and short 5 times the S&P 500. It very rarely goes down. Stocks do trend up. The UVXY strongly trend down. You cannot time the volatility spikes. And then on the other side, the short, well, I mean, how fast do you want to blow up your account? So everything should be done on VXX and VXX options. If you can be profitable for a number of years doing that, then maybe graduate to something else. But I would say just forget you even heard of UVXY. And to be honest, trade SVXY or even ZIVB, trade those. And then if you needed a long vol product, VIXM, trade those. They move slower, they're more controllable. You don't make less money because remember, losses hurt your progress more than gains help you, right? If you start with 10 grand, the old thing, make 50%, lose 50%, you're not back to break even. You're down 25%, right? The losses hurt much more. So even though you might think, oh, SVXY, it's a watered down product. Who trades that stupid thing, right? Minus 0.5. Only rookie traders need that. The training wheels on the volatility ETF. No, that's not true because the risk management is also taken care of. So you don't bleed down the other side, and you can actually make just as much or more money trading the SVXY than you can with the UVXY. So don't forget that unless you have a proven, solid, consistent system of avoiding drawdowns, just use the watered down products. They're way safer and you'll make way more money. Elon is 20 to 25 kilograms more. It wouldn't matter if he was 50 kilograms more. I'm not saying Zuck's some world beater, like he's going to go to the world championships or something, but he's trained and he's at a level that is significant enough that Zuckerberg could submit anybody 50 pounds heavier than him that's untrained. If you just get some random dude like Elon Musk off the street, and let's say he's 50 pounds heavier than Zuck, his level in jiu-jitsu at purple, maybe brown, I don't know, but I don't think he's a black belt. Maybe he is, I don't know. But he's good enough already. I think people just wildly underestimate the effectiveness, A, of jiu-jitsu, and B, the laughable gap between somebody who's untrained versus somebody who's had some training. It doesn't even really take that long to be able to absolutely manhandle somebody much bigger and stronger if you have the training and the technique. So unless Elon behind the scenes is doing, some training, and I've not seen any Rocky style training montages from Elon. I've seen plenty from Zuck. It's almost physically impossible to imagine him winning. How? What could possibly happen? So yeah, that's my take on the whole thing. Love to see it. I think it'd be comical, but it'd be quick. It'd be real fast. All right. Any more questions? Any more UFC questions? Trying not to miss any because I did screw up today and I gave everybody the wrong time. So I'm just trying to make sure I get every single one. There's something about Berkshire Hathaway. It's just a link. So with respect to this, I'm sure that's a legit link. That looks just fine. But just remember, there's a few ground rules in our live streams that will possibly get you banned from either YouTube directly, which sometimes really pisses people off. They say, oh, I left a comment on your video and YouTube blocked it. Yeah, they do that sometimes behind the scenes. But also sometimes for me, like I won't open that or anything, but just remember not to link third-party links because that can be a problem. YouTube doesn't like that. They attempt to have their algorithm fishing for, scammers. And so oftentimes third-party links, even an account in reasonable standing, might actually have some problems. So, but that one said Berkshire. I'm sure it's fine. I'm sure it's just the annual letter or something. All right, we're done. Okay, so that's it. Don't buy and hold. Don't build those stupid pie charts. And don't bet $100 that Elon Musk can beat Zuckerberg, because he can't. So there we go. There's the live stream. We'll come back next week. I promise I'll get the date right or get the time right. I think maybe tentatively, maybe we should switch back to a Friday. We've done a couple weekend ones in a row. Let's go back to Friday. And I'll come up with more topics next week, and there's always more questions. So thanks, everybody. Oh, look at that. I was just about to tune out, and then there's one more. But again, it's about VIX options, and I have to punt on the question. I don't know. Like I said, here's my leftover time. I told you, 2 hours a day. That's all I get. I mean, I'm already working 12 hours a day. I'm working as hard as a human can work. And it's just, it's going to happen. It's going to happen. But I can't talk about it until it launches, because there are some moving parts there. Don't want to make it sound like it's super complex. It's fine. Everybody can trade it, but you need to know what to do. So give me some time, 2 hours a day. Like I said, I'm not a YouTuber. I'm not a content creator. I'm not somebody who is going to have polished stuff, and I'm never going to have a YouTube play button or anything like that. But you got to remember, there is a massive difference between somebody who's a good investor and someone who's a good content creator. Don't follow content creators. Follow investors who also post their content. And just that alone, you could probably sidestep 90% of the scammers out there. If they're pumping out 5, 6 pieces of content a week, and it's polished and it looks amazing, red flag, because I know I don't have that time, so I don't know why they do. And if you see somebody all over Twitter all day long, they're just tweeting, again, who has that kind of time? We work. So red flags everywhere. All right. Take care, everyone.